Welcome to the final video in our series, Understanding Mortgage Acceleration, the system that slashes years off any mortgage and saves thousands in mortgage costs. Here, we'll introduce the concept of the mortgage checking account. It's how the homeowner implements mortgage acceleration. The mortgage checking account is simply a revolving credit account. Think of it as a combination of a checking account and a mortgage account, having the features of both. As in any checking account, money can be deposited into it and bills can be paid from it. Like a mortgage account, any money deposited into it reduces the balance of the mortgage loan. Due to the unique way that the mortgage checking account is utilized, it will have a negative balance and reflects a portion of the homeowner's mortgage loan. There are several types of revolving credit accounts suitable to be used as a mortgage checking account. One is a checking account with an overdraft line, usually called Checking Plus. Another is a home equity line of credit, or HELOC. A third are credit card lines of credit, but do not use a credit card as your mortgage checking account. Once a revolving credit account is established, activate it as a mortgage checking account simply by writing a check and depositing that amount into your primary mortgage loan. Be sure to tell your lender to apply it to principal. As in our previous two videos, we're using an amount equal to our first year's principal reduction, $4,215. Also, as paychecks are received, they are deposited into the mortgage checking account. At the end of the month, our mortgage checking account shows the initial withdrawal and all of our monthly deposits. Throughout the month, the average daily balance of the mortgage checking account is rising, but interest has been accruing on the line of credit. What was the interest cost for the month? First, we'll pay our bills toward the end of the month, including our monthly mortgage. Over the course of the month, the mortgage checking account balance went from a negative $4,215 to a negative $3,915 after adding all our paychecks and paying all our monthly bills, so that the mortgage checking balance increased by $300, and the credit line will be repaid at that rate in 14 months. We can calculate the monthly interest that accrued by calculating the average daily balance and the amount of interest that accrues each day during the month. Based on a 10% interest rate, interest on the line of credit was $20.38 for the month. Using the mortgage checking account, mortgage debt has been reduced by over $4,200. Interest on the mortgage has been reduced by over $10,500, and the $4,200 line of credit will be repaid in only 14 months and cost just $270. We've used an example of a $250,000 mortgage, 4.5% interest for 30 years. We set up our mortgage checking account and transferred $4,215 from our mortgage checking account to our primary mortgage. There's been no increase in overall debt in doing so. Then we've used our mortgage checking account just like a regular checking account. Our mortgage checking loan will be repaid in about 14 months. Interest on the mortgage checking loan, just $270. Savings on our primary mortgage, over $10,500, and over a year of payments. There have been no change in our monthly mortgage payments and no personal funds or savings used to do this. Of course, no bank will tell you about mortgage acceleration. Use the Mortgage Magic system and you'll save up to 20 years of mortgage payments and hundreds of thousands of dollars of mortgage interest. And just think how much greater your retirement nest egg will be using this system.